Every collapse isn't chaos. It's a wealth transfer in disguise. When banks shutter and prices spiral, a handful of people surge ahead, not by chance, but by how they're positioned before the cracks appear. If you're watching from the sidelines while markets melt and costs soar, there is a concrete reason the winners aren't you. The real story isn't who wins or loses, but how the gap is decided, long before most ever see it coming. Let's break down how that happens. Winners and losers aren't just labels. They are roles set by how people and institutions are positioned when the system lurches. Winners are those who hold assets that can flex with the storm. Real estate that rises with inflation, stocks that rebound, businesses able to raise prices as costs climb. Debtors can be winners too when loans are fixed rate and the currency collapses because they pay back in money that is worth less each month. Some winners are exporters or commodity producers, earning in dollars or hard currency, while local expenses stay cheap. Others are insiders, such as banks with a direct line to emergency funds, major firms with government contracts, or people with early access to policy decisions before the headlines hit. Losers tend to be on the other side of those lines. Wage earners with fixed paychecks, watching rent, food, and bills climb faster than income. They are retirees and pensioners whose savings buy less each week. They are small business owners who cannot raise prices or negotiate new terms. Households with high monthly payments and little margin are forced to cut back when prices spike or jobs vanish. During the 2008 crisis, large United States corporations saw profits rebound to over $2 trillion by 2013, more than double what they earned before the crash. Most households, meanwhile, faced stagnant wages and rising living costs. In Argentina's currency crisis, exporters selling soybeans in dollars saw windfalls as the peso collapsed, while urban workers and savers lost access to their own money. In Weimar Germany, borrowers paid off debts in worthless marks, while cash savers and pensioners were wiped out. These are not quirks of history. They are the outcome of who owns what, who owes what, and who gets to move first. The difference between gaining ground or losing everything often comes down to whether you are holding assets that can reprice or stuck with claims that shrink when the rules change. The system does not pick sides by luck. It rewards those with leverage, buffer, and access, and it leaves the rest scrambling to keep up. Money never waits for headlines. In every major breakdown, the first moves happen quietly, inside boardrooms, in the bond markets, across trading screens, long before the public sees panic on the front page. In 1907, as New York's trust companies ran low on cash, call loan rates spiked from 2% to 20%, then soared above 70% within days. These signals flashed in the private wires of bankers and brokers, but barely registered outside Lower Manhattan. Depositors at Knickerbocker Trust started pulling out millions on rumors, while the city's biggest lenders watched liquidity dry up by the hour. J.P. Morgan, already the most powerful banker in America, gathered 50 of the city's top financiers in his library on a Saturday afternoon. By Sunday night, they had pooled over $25 million, more than half coming from Morgan himself and his closest allies. This money did not go to everyone. It was handed out selectively to trusts and banks Morgan judged solvent enough to survive, while others like Knickerbocker were left to collapse. The decisions were made in private, guided by inside knowledge of which firms had enough collateral and which were too exposed to save. The public only learned the details days later, after the runs had emptied vaults and the stock market had dropped nearly 50% from its peak. Newspapers caught up after the fact, but the real triage had already happened. Market distress showed up first in call rates and clearing house bulletins, not in headlines. Insiders tracked these numbers in real time, repositioning funds or calling in favors before the system buckled. This sequence repeats across history. Money moves before the break is obvious. Those with access to private signals, credit spreads, funding rates, internal memos get to act first. Everyone else reacts to the aftermath. The system rewards speed, information, and connections, not just luck or hard work. Asset owners sit at the center of every modern rally. In 2020, while millions faced layoffs, the S&P 500 rose more than 16% by the end of the year. Tech giants alone added trillions of dollars in market value. People holding stocks, real estate, or businesses with pricing power saw their wealth multiply as fiscal stimulus and low interest rates pushed asset prices higher. Fixed-rate debtors found themselves paying down mortgages and loans with dollars that lost value month after month, that shrank real debt burdens as wages and prices climbed. Exporters and commodity producers captured windfalls when local currencies weakened. During the recent surge in the US dollar, American exporters saw overseas profits balloon, while firms in emerging markets with dollar revenues gained ground as their home currencies slid. In Lebanon's collapse, insiders and connected currency dealers accessed US dollars at the official rate, then flipped them on the black market for profits that sometimes reached 10 times the original value. These positions are not random. They are built on ownership, access, and the ability to move early, traits that repeat in every crisis and define who sits on the upside when the system resets. For most people, the traps are built into everyday life. A wage earner with a fixed paycheck faces a monthly squeeze as rent, groceries, and utility bills climb faster than their income. In the US, average grocery prices rose nearly 20% from 2020 to 2022, while median wages barely kept pace. Insurance premiums and energy costs often jump in the same cycle, leaving less room for anything beyond the basics. Cash savings meant to be a safety net lose value quietly, especially in years when interest rates lag behind inflation. In the decade after 2008, deposit rates hovered near zero, eroding the real value of savings even as official numbers looked stable. Small business owners run on tight margins, locked into long leases or fixed supplier contracts. When revenue drops, like during the COVID shutdowns, thousands shuttered, unable to renegotiate or absorb the loss. Households with high fixed monthly payments and no buffer are forced to cut back, miss bills, or take on new debt just to cover rising essentials. These are not rare exceptions. They are the default setting for millions, trapping people in positions where any shock, whether job loss, price spike, or policy change, turns routine stress into crisis. Berlin, 1923. Rentenmarks replace wheelbarrows of cash, close shots of swollen banknotes, empty shop windows, and pensioners in a breadline. Industrialists erase debts, while pensioners queue for bread. Debts vanish, savings do not. Moscow, winter 1995. State auctions sell Norilsk nickel and Yukos for a fraction of their value. Auction footage, factory signs, and long food queues. A handful of bankers walk away with the country's core industries. Insiders claim control as millions trade privatization vouchers for groceries. Buenos Aires, December 2001. The Corralito shuts down bank withdrawals, closed bank doors, ATM lines, and currency boards flickering. Exporters already holding dollars ride out the devaluation. Middle-class savers watch peso accounts shrink overnight. New York, 2008. As Lehman falls and the troubled asset relief program passes, big banks secure lifelines and buy distressed assets. Trading floors, foreclosure signs, and unemployment lines fill the footage. Homeowners face eviction notices and long lines for benefits. Lifelines go to institutions, not individual savers. In every crisis, early movers consolidate power and assets. Those without access or a buffer absorb the shock. The pattern repeats across currencies, borders, and decades. Most people hold on, convinced things will return to normal. This is called normalcy bias, the tendency to underestimate both the speed and the severity of change. In the early days of Argentina's crisis, countless savers left money in peso accounts, trusting government reassurances right up to the Corralito. In Weimar Germany, teachers and shopkeepers kept savings in marks, expecting stability. By the time reality set in, their options had vanished. Institutions and insiders with faster access to information and tools moved early. Ordinary households lacking that speed and that scale waited for certainty that never came. The system rewards those who act before the crowd, not those who hope for a return to the old order. That is how collapses quietly sought winners from losers, well before most people realize the rules have changed. Today, global crises move faster than ever, reshaping fortunes in weeks, not years. As nearly 60% of adults face shrinking savings and rising essentials, the pattern repeats. Position decides the outcome. In every upheaval, the system rewards readiness. The next transfer is already in motion. Thanks for watching.